Namaskar and thank you for tuning in to the Economic Brief, our weekly program on news related to the economy from an Indian point of view. Let's look at what's on the program this week. Over 716 applications worth 3,141 crore rupees already approved under the credit guarantee scheme for exporters launched in December. There's a renewed investor interest in Venezuelan debt, but it's not mainstream investors, it's specialized distressed debt funds that are betting on a turnaround. Germany's EV recovery exposes uneven transition as Europe's auto industry faces an economic stress test. Indonesia hits rice self-sufficiency for the first time since 2008, producing 34.71 million tons in 2025. But before we move into our top story, let's listen to member of Niti Aayog, Dr. Arvind Virmani, an eminent economist. He's describing the idea behind schemes to boost exports in India.
It is tied to exports. We have to keep in mind that the tying to export is more because of the desire to make sure that the quality of production that comes up and the cost competitiveness. So quality and cost competitiveness. So new manufacturing capacity must be of scale to meet cost competitiveness, but must be of quality. And the only way to ensure that, without daily interference or more, non-EODB kind of regulatory stuff, is to have a export clause in it. So that kind of ensures that it's competitive. So the point is the objective of these schemes is to create an Atmanirbhar manufacturing sector, but to do it in a way which is both quality and cost competitive. It's not just to protect inefficient and low quality enterprises.
So let's take a look then at some of the measures being taken recently for the export sector in our country to boost exports. The credit guarantee scheme for exporters, this has been operational since the 1st of December 2025 and it's through the Jan Samarth portal. And this is by the Department of Financial Services. It's implemented by the National Credit Guarantee Trustee Company. We've seen several applications, 1,788 applications already received, totaling about 8,000, almost 600 crore rupees. And of these, 716 have already been approved, which amount to 3,141 crore rupees. So significant interest in this scheme already. Let's move on to a little more detail about the scheme. It is, of course, because exports is important for our economy. We can see that exports are contributing approximately 21% of India's GDP. And that is also because it's generating substantial foreign exchange, apart from, the remittances that are coming in from Indians who live abroad. And apart from that, FDI, of course. So there's plenty of foreign exchange coming in, obviously, from exports. And this is generating substantial foreign exchange earnings for the country. It's also generating more jobs. This is a repeat. It's generating more support for about 45 million people who are directly or indirectly employed in this sector. Moving on then to our next slide. The MSMEs, they account for about 45% of the total exports in the country, which is in the area of, let's say, textiles. There is apparel. There's handicrafts, leather exports, food processing industry products. There's also pharmaceuticals on the smaller scale, then gems and jewelry. So the MSME sector is accounting for a huge chunk of India's total exports. This is, other than the refined petroleum exports. But they serve as the backbone also for India's export ecosystem because, as we said, they were creating so many jobs and they drive job creation, innovation and inclusive growth. About 45 million people associated with the sector getting direct jobs or indirect jobs from the export sector and the MSMEs. So what is the objective of this scheme, the credit guarantee scheme for exporters? It is going to be providing 100% guarantee on incremental credit, that is additional credit of the government. So the government is going to cover this in a sense. The government is acting as the guarantee or the guarantor for any amount that is being entered into new loans and additional loans. 100% guarantor the government is. It's going to enable collateral-free lending. The total corpus is about 20,000 crore rupees. And it's going to ensure, obviously, that these companies remain competitive, cost competitive, ensuring liquidity, stability, and business continuity for the exporters. As we heard the eminent economist Arvind Virmani saying that the idea is that these companies have to be competitive in the international market. Now let's move on to our next slide. Well, we did say that the implementation is through the Department of Financial Services, and it's in coordination with the National Credit Guarantee Trustee Company Limited. That's what the NCGTC is. So it's actually this company that is acting as the guarantor for these new additional loans that will be coming out. It's open to both MSMEs as well as non-MSMEs exporters. So the non-MSMEs exporters are important. They are, those are the exporters who would be, we look at non-MSME sectors, those sectors which, those companies will have about 80% of their products are being exported. So they have to have a turnover, and they should also have an existing association with exports in terms of working capital and the like. So working capital loans of up to 20% for the existing sanctions limit. So they have to have an association already with exports. Moving on to our next slide. So the basic aim, as we see, is to strengthen exporters' capacity to enter and also scale up in new markets. They're going to scale and enter new markets. After all, this is a turbulent time for global trade, and it's important to back the exporters. And this kind of a scheme is going to reduce the risk for the exporter. Hence, he's able to enter the new market and also participate in it, bringing his products. India, of course, has worked out several FTAs. India's products, almost 100% of them, are available to these. They have market access to many markets of the world and almost duty-free in most of these countries. So to improve the global competitiveness of the Indian exports, that's the broad aim, and to increase the confidence also amid the uncertainties in the global economic conditions. Those are the aims of the impact of the credit guarantee scheme. Moving on to our next slide. So we are looking at another scheme, which is also the Export Promotion Mission. This is another mission that is being set up also to promote exports in the country. Cabinet had approved the funding of 25,060 crore rupees between the financial year 2025 and 31. Its focus is also again on the MSMEs and also first-time exporters, and this is for market diversification, which is to find new markets. The key components are two types: Niryat Protsahan and Niryat Disha. The Protsahan is basically for financial support mechanisms. These are trade credit and guarantees. And the Disha is also direction, which implies that they will be looking at helping these companies to deal with issues like branding, logistics. Those are the kind of issues that intelligence sharing, all these sort of things, which would help that company to perform well in the international market. So let's look at some of the other interventions in exports in our final slide. These are also important. The interest subvention scheme, which is showing a base of 2.75%, base rate of 2.75%, additional incentives for emerging markets. And then there is the credit guarantee of up to 85% coverage for micro and small exporters. So all this, of all the schemes combined, the outcomes, we can say, is to lower the financing costs, to improve access to credit, and also to give a stronger global presence and diversified export markets for the Indian exports. So we can clearly see that this has been a significant contribution to India's export direction. Now, before we discuss India's export promotion initiatives, let's look ahead, at this next story on Venezuela debt. Here, the White House Press Secretary, Caroline Leavitt, she's explaining the U.S.'s policy towards both Venezuela as well as Greenland that is reshaping the nature of the oil market.
This was a deal made by the president and his team with the Venezuelan interim authorities. This will benefit both the American people and the Venezuelan people. And Secretary Wright and the Department of Energy are working with the interim authorities and also with the private oil industry to execute on this historic energy deal. That's not only good for the United States, but it's also going to revive the prosperity, the safety, the security of both the United States and Venezuela as well. The U.S. is selectively rolling back sanctions to enable the transport and the sale of Venezuelan crude and oil products to the global market. And I would point out that the acquisition of Greenland by the United States is not a new idea. This is something that presidents dating back to the 1800s have said is advantageous for America's national security. The president has been very open and clear with all of you and with the world that he views it in the best interest of the United States to deter Russian and Chinese aggression in the Arctic region. And so that's why his team is currently talking about what a potential purchase would look like.
Well, to help us understand these stories in greater detail, we have with us Dr. Amit Kapoor, Honorary Chairman of the Institute of Competitiveness, for Competitiveness, I beg your pardon, and a well-known economist. Thank you very much, Dr. Kapoor. First, let's look at the CGSE. How does this, give confidence to exporters to take on uncertainties of global supply chains?
So, this is a very important initiative, Mark, in terms of what has really happened and done. If you really look at the scheme itself, there are two very important words that are actually being used. And what earlier Dr. Vermani had also said. One was Niryat Protsahan, that is motivation that has to be given, in Niryat Disha, which is the direction. And what Dr. Vermani said was very important, that there are two things. One is quality and cost competitiveness. So the biggest challenge, given the kind of global headwinds that we are facing right now, is the cost competitiveness. And what do we need to do for that? We need to make sure that the cost of production actually reduces. The cost of money in terms of whatever is being taken by the MSMEs has to really get reduced. And this is exactly what the government has done. If you really look at the positive things, so lower cost of working capital for eligible MSMEs is something very, very important. And the second thing is that there is this whole Niryat Disha aspect, which is about quality. For the first time, we are effectively saying in very strong words that India needs to improve its quality in terms of really becoming relevant in the global market. And this would also lead to something very important, and that is that you're really trying to say that we are going to diversify our exports and move away from normal basic products to value-added products. And if you're doing that, that is something very important for the economy at large. And given the kind of scale that this industry has, the scale itself is gargantuan, 45 million people, that is close to about 4.5 crore people who are directly or indirectly employed within this export-led institutions. And then, of course, 45% of total exports are coming from MSMEs. So this is something which is a very important step towards improving the competitiveness of the industry itself. But I think this was a long time coming. I also foresee some positive aspects coming into the budget as well after this. So this is what I'm really looking at.
So how well does this credit guarantee scheme for exporters combine with the PLI and other export promotion incentives? I mean, it's a collective effort, isn't it?
Oh, definitely. If you really look at the PLI, the production link incentive scheme was majorly for, say, the larger enterprises or whatever, but they were becoming the anchor enterprises. And around that, there would be small ancillary or medium and small enterprises that will come up. For example, if you talk about, say, Gurgaon, where the automotive factories are, but there are a lot of large MSMEs that have actually happened over a period of time. So this is exactly what the PLI scheme has done. So PLI creates an anchor firm, which is going to be a very massive producer, and there are going to be allied firms or medium and small enterprises that are going to happen. So this is a collective effort. So there is a continuation of thinking, because when you talk about semiconductors or when you talk about mobile phone is just not one single thing that you're assembling and manufacturing mobile phones. There are a lot of other things that happen with mobile phones, which is going to be catered for by the MSME sector itself. So this is a very important collective cluster-based approach that the government has actually looked at. And it's the right step, because when you talk about clustering, this also means that you're improving or increasing the depth of clusters, the spread of clusters that is important, because where diversified set of units will come across. And remember, I think there's one very important aspect that a lot of people will not talk about. When clustering happens, innovation also peaks up. Because India is also looking at innovation, and India has improved on the global innovation indices. Right now, we are ranked 38 or 39 in the world, which is significant, with the kind of improvements that India has actually seen over the last few years. So what we are saying is that this cluster-based approach will also improve the level of what you would call as innovative capacity within the firms. And government also recognizes that, like most of the R&D effort that has happened in India is effectively done by the government. It is time that the private sector also starts investing in it. So this would be a motivation to that direction as well.
Okay, indeed. Do stay with us, Dr. Kapoor, for our next story on Venezuela debt. Now, the fall of the Nicolas Maduro government, it has thrust Venezuela's long-festering debt crisis back into global focus. The country's financial collapse, marked by billions in unpaid government as well as PDVSA bonds, now collides with shifting politics and fragile hopes of recovery as creditors circle and also oil deals emerge. Venezuela's troubled paper is suddenly back on the radar, turning a nation's struggle to rebuild into a high-stakes test for investors and policymakers alike. Here's our report.
Maduro's fall has put Venezuela's debt crisis back in the spotlight. One of the world's largest unresolved sovereign defaults is center stage. Years of collapse in U.S. sanctions shut the nation out of capital markets, and by 2017, Venezuela defaulted on billions in government and PDVSA bonds. Unpaid debt and legal claims have swelled Venezuela's liabilities. Analysts see $60 billion in defaulted bonds, with total obligations up to $170 billion. Against a GDP of $82.8 billion, debt stands at 180 to 200%. Oil output has collapsed, inflation soared, and poverty deepened. Though production has stabilized, low prices and sanctions leave little room to pay. Caracas and Washington have reached a deal to export up to $2 billion worth of Venezuelan crude to the United States.
It's true that it's going to take a while before actual oil production in Venezuela will really pick up again. But we know that markets very often trade expectations, trade forecasts, and in this world, they will expect that oil production out of Venezuela will pick up over the next month and years.
Venezuelan bonds, once left for dead, have surged over 20%. Investors see opportunity in turmoil. Defaulted for years, they now hint at revival under new leadership. Hedge funds bet on debt restructuring that could unlock billions. It's risky, political chaos and legal battles remain, but for those chasing big returns, Venezuela's troubled paper is suddenly the hottest ticket around.
What are the goals of this imperialist war? To install a U.S. puppet government that will turn over Venezuela's oil and mineral resources to U.S. corporations and to force capitalist hegemony in Latin America.
With $19 billion in claims against downstream company Citgo's parent PDV far exceeding its assets, Venezuela faces mounting pressure from bondholders, arbitration claimants, and bilateral lenders like China and Russia. Absent IMF ties and constrained by U.S. sanctions, its debt crisis remains unresolved. As creditors circle and politics shifts, the world watches one of the largest sovereign defaults collide with a nation struggling to rebuild with U.S.-style corporate takeover. The Economic Brief, DD India.
Well, let's turn to Dr. Amit Kapoor once again, who continues to be with us. Dr. Kapoor, does all this that's happening in Venezuela, let's not look at the legal point of view or the politics and all that, does it make economic sense?
So, the larger point, as you say, is there an economic sense to it? One, we have to understand that there is a severe debt crisis that the country faces. And how do we resolve for that debt crisis? Because as you said in your earlier report, $170 billion is the kind of debt crisis that is there. And PDVSA, that is the petroleum company of Venezuela, which is one of the biggest defaulters. So what is it that we can do to recover? And if you're already talking about surge in bonds, there is a positive futuristic thing that is happening over a period of time. Because even if the politics is improving in Venezuela without a doubt, the math is going to be slightly tilted against Venezuela on this. But if you really look at the uncertainty over ownership, prolonged litigation that can actually happen because of assets, there are going to be challenges. But this is something very interesting that can happen because if you're able to invest in the petroleum sector out there, there is a huge potential that happens because Venezuela has the largest oil reserves in the world. I think 17% of the world oil reserves happen to be in Venezuela, underexploited. And if that energy can be taken out of the ground, if the oil can actually get used, there can be a lot that can be done. But this is where, like Citgo, which is a US-based oil company owned by Venezuela, how it can actually perform. Can it actually go there and create more assets, create capacity within the in Venezuela? If that can happen, if more investments can happen, yes, things can stabilize because it is not something very brutal in terms of say 180 to 200%. There can be restructuring that can happen.
Yes.
But the larger question is going to be that how sanctions are going to get relieved over a period of time. As the statement of the press secretary from the White House, yes, of course, she said that there are some relief in sanctions that can actually happen. If that happens and the flow of energy starts happening, that is, flow of oil starts happening, there is a certain positive thing. But it's going to be a long, hard battle for Venezuela to really come out of it. It's not going to be something which is going to happen within a day. It's a marathon. It is going to take years for them to really come out of it.
Final question, what impact will all this have on Indian oil imports and refined petroleum exports from India?
I think the question is that without a doubt, India is one of the most important refining locations in the world. If you really look at Jamnagar, it becomes one of the finest locations. And looking at the Venezuelan oil, which is not something which is very clean, Indian refineries tend to get that benefit because that dirty oil or not something which is very good comes to India. Reliance is one unit which can really do an exceedingly good job of it. They're supposed to be one of the finest refineries in the world. And a lot of people just don't even look at it. Like, in fact, they're one of the most cost-effective refineries. So there could be a whole huge positive thing that happens in terms of the trade that can happen. There are other mounting pressures, geopolitical pressures that exist along at this point in time. So India does see an opening in terms of how it gets out of the global headwinds and with the kind of clash that happens. So there are those politics involved in it. But I, on a larger scale, I think there is a positive economic benefit for Indian oil companies over a period of time. And this will also reduce the oil prices over a period of time.
We'll leave it there. Thank you very much, Dr. Amit Kapoor. Thank you for enlightening us on the situation in Venezuela and its impact. Now, moving on to our next story. German electric vehicle market is back in the fast lane. Now, after a sharp slump last year, the EV sales, they've rebounded strongly in 2025, driven in part by international automakers, Chinese manufacturers, in fact, like BYD. They are making unprecedented inroads, overtaking Tesla in global rankings, even as policy debates and expired US tax incentives add pressure on established players. Diptanshu Kashyap has this report for us on Europe's largest car market.
After a year of sharp reversals, Germany's electric vehicle market found its footing again in 2025. Sales surged 43.2%, lifting EVs to 19.1% of all new passenger car registrations. The rebound followed a bruising 2024 when sales fell nearly 30% after government subsidies were withdrawn, and it unfolded amid an intensifying debate over how Europe's largest auto economy should meet EU climate targets and proposed restrictions on combustion engines.
Und es gibt den Gesetzentwurf der Bundesregierung.
We want to reach our goals, but we want to do so with technological openness. We want to reach them with a form of mobility, which will also preserve jobs in Europe, especially in the German automotive industry.
Even as policymakers argue over the pace of transition, competitive pressure is reshaping the market. Chinese manufacturers are moving from the margins into the mainstream. BYD, which overtook Tesla to become the world's largest electric vehicle maker, increased its German sales by more than 700% to over 23,000 vehicles, capturing a growing share from a low base. Across Europe, BYD's expansion has continued despite higher EU tariffs on Chinese-made electric cars. and accusations of state-backed price advantages. The shift is tightening. The squeeze on established players, Tesla reported a second consecutive annual decline in global deliveries. Falling to 1.64 million vehicles, demand softened after US tax credits expired, while intensifying competition from Chinese brands and European automakers such as Volkswagen and BMW eroded momentum in key markets, even as global EV sales rose 28%.
The EV recovery for Germany highlights how uneven the transition remains. The demand is recovering, but not at the pace policymakers once hoped for. With tighter environmental goals, fragile growth, and rising competitive pressure, the shift to electric mobility is no longer just an environmental challenge, it's an economic stress test for Europe's largest industrial sector. In New Delhi with camera person Gaurav Giri, this is Dipanshu Kashyap for the Economic Brief, DD India.
Well, Indonesia is celebrating a major milestone in food security, achieving rice self-sufficiency for the first time since 2008, producing enough to meet domestic demand without imports. This success comes amid repeated climate shocks, with flash floods in North Sulawesi wreaking havoc on communities as well as local economies. Well, experts warn that while the rice harvest is a triumph, natural disasters are posing risks and rising risks, that is, to the country's growth and fiscal stability. Dipanshu Kashyap has this other report, and we leave you with his report. Thanks for watching the Economic Brief. Namaskar.
Indonesia achieved rice self-sufficiency for the first time since 2008, producing 34.71 million tons in 2025, enough to meet domestic demand without imports. The milestone came just over a year after he took office, boosted by subsidies for farmers and streamlined regulations, and represents a major victory in his push for national food security.
Today we have recorded an important victory. No nation can be truly free if food is not available to its people. Indeed, I set a target of 4 years for food self-sufficiency. Thank you to the entire agricultural community in Indonesia. You worked hard, you were united, you were cohesive, and you delivered. What was targeted for 4 years, you delivered to the nation and the country in just 1 year, achieving self-sufficiency.
But the gains come as Indonesia grapples with repeated climate shocks. Flash floods in North Sulawesi killed at least 16 people and forced hundreds into shelters. Less than a month after catastrophic floods and landslides in Sumatra killed more than 1,000 people, highlighting the scale and persistence of weather-driven disruption nationwide. World Bank warnings highlight that floods and landslides pose a downside risk to Indonesia's economic growth. Damage is expected to pressure state revenues and slow regional growth, adding fiscal strain even as reforms aim to sustain momentum. Fresh flood warning in North Sulawesi adds to those risks, damaging homes, roads, and local infrastructure and disrupting economic activity. Economists warn that repeated climate shocks could compound growth pressures by hitting agriculture, logistics, and household incomes across multiple regions at once.
Indonesia's rice self-sufficiency is a landmark achievement, but the floods underline how fragile that progress can be. As climate extremes intensify, food security is no longer just about production. It is inseparable from disaster preparedness, fiscal resilience, and long-term economic stability. In New Delhi with camera person Gaurav Giri, this is Dipanshu Kashyap for the Economic Brief, DD India.